Well, equity futures are fluctuating after the S&P had its biggest weekly gain since February. This is all as concerns about Japan's nuclear crisis offset speculation the economy may be strong enough to pare down stimulus coming out from the Fed. We are joined by JPMorgan chief U.S. equity strategist Tom Lee back with us. And Tom, as I recall, the last time you were on, you said you were looking for a correction in April. Are you still looking for that?
Betty, I think last the week of March 11th was probably marking the low we were looking for. We were looking for 1250, and I think the combination of escalation in the Middle East plus the natural disaster, I think really accelerated the process. So we're pretty sure that 1250 was the low for the year.
So you're not looking for a correction anymore at all in April? Because last time when we were on, it was after the earthquake, you said, you thought that was going to be pushed, that selling was going to be pushed over to April.
That's right. Well, what we're really sort of probably the playbook we're looking at right now, Betty, is the market's responding to the anticipation of weakening economic data, right? Because we know oil and the slowdown from the earthquake's going to hurt GDP. But at the same time, I think we're seeing the normal reaction to post-nuclear markets, which is usually a very, very strong market for the next 3 months. And also the fact that active managers are really trailing their benchmark. So it to us feels like we're going to finish March strong. April April, it's still kind of early to read the economic data, but April could be choppy, but we think that 1250 really holds for the year.
Hey, Tom, it's Dominic here. One of the things you talked about, that playbook, right? What would make you call an audible there? What would make you say, hey, I see something different now, maybe a correction is due? Is it a macro concern? Is it some kind of a rate concern here in the U.S.? What's it going to take for you to make that judgment call change?
Well, I think the things that always hurt markets are external events. So I think if there is a real flare-up in the Middle East, so in one of the key countries like Saudi Arabia, starts to see a lot of political unrest, I think that really changes the call. I think $140 oil on WTI is a real threat to that view. And I think one way for investors to really track this is really to watch the yield curve. Our favorite spread to watch is the 10-year versus 30-year spread, which remains pretty steep. So to us, it means markets, even though we're worried about oil, it's not enough to change people's expectations about economic growth.
And Tom, it's John Erlichman. Bring it back to stocks. Your target suggests that the market could go up another 8.5% this year, but not all stocks are created equal. You've talked in the past about liking bank stocks because they lag the market. But what's going to do better than that 8.5%, and what's going to do worse?
Yeah. Well, I think in the next few weeks, cyclicals really make the most sense because, when investors really want to try to close this performance gap, they're seeking beta. And when they're in that mode...
What's beta?
Well, beta means if the market's up 10, they want to go up 20. So typically, they're going to be really gravitating towards the cyclicals. Whenever we sort of see a performance chase, cyclicals are basically their beta proxy. But as you get from the summer into year end, without question, groups like healthcare start to look very attractive. So we're starting to figure out when the risk reward is attractive to sort of think about healthcare, which we rate neutral currently, but at some point it's going to be an outright buy.
Tom, Treasuries this morning are betting on a possible departure of the Fed from QE a little bit earlier than anticipated. What does that bode for equities?
Well, I think QE2, the early expiration, even the ending of it, has been a topic for investors since early February. So it's, in some ways it's not catching people by surprise, but the Treasury should naturally lift. I mean, when QE ends, you're taking a huge buyer out of the market. I think equities really worry about rates when you're sort of in the 10-year around that 4.2, 4.3. So we've got a lot of room for 10 years to rise.
And Tom, quickly, Scarlett was telling us about companies deploying their cash now. Does that set the stage for some type of acceleration in a rally this year?
Absolutely, because there's going to be some companies that are very opportunistic, knowing that look, we know companies have record free cash flow. And they're getting record pressure to deploy this because we're looking at cash positions as well as free cash flow generation. And without question, if we see the markets turn down because of pre-announcements for oil, this may accelerate M&A. I mean, M&A is sort of going to be an underlying bid.
Okay, Tom, sorry, we'll have to leave it there. Tom Lee, the Chief U.S. Equity Strategist for JPMorgan.